My role today is just to help you to understand, to try and explain some of the principles of financial planning and some of the resources. We're going to talk about tonight building your financial plan, a continuation. So what we need is a strong base. We need to consider non-controllable events. We need to consider controllable priorities, and we need to look for growth opportunities, because not all of us can get to age 55 or 58 or 60 and be on track. Sometimes we have to kick it up a notch or two. And particularly in these COVID times we're in, we don't necessarily know what's coming up next. And so it becomes very important that we start from a strong base and work our way through to wherever we need to be, whether you're 16, 18, 38, 68, or 88. I hope you will find this worthwhile. So part of the financial planning pyramid, if you've ever seen this, this is something you'll see in lots of financial institutions across this country, is to build, beginning with a financial plan, and stemming from the financial plan then becomes your wishes in the event that you don't make it long enough to see your financial plan through to the end. So the first thing you need to do, and you need to consider, is what your goals are. And really that's in long and the short of it, a budget is what your goal is for the month, right? It's a spending goal. This goal here we're talking about tonight is more for retirement, and you need to consider that today, more so than ever, with the exception of COVID, there is a longer life expectancy. And you want to maintain a certain lifestyle. Presumably you don't want to retire in poverty. I know I have no interest in retiring in poverty. And you want to make sure that you protect yourself as much as you can from uncontrollable events. So you're going to see through this presentation, we've incorporated a number of items from financial planners standards in this country. And this is a graph that you'll see quite often. So early on in life, we're building for the future. We have our basic living needs, and then we're saving for retirement, for education purposes, for whatever comes along. And then we have our lifestyle, which is our wants. So these are our needs. These are our wants up here. So the things that allow us to enjoy it, whether it's travel or whether it's a boat or whether it's a motorbike or whatever it is. As you go through life, then those sorts of things will change a little bit. The need for protection maintains itself pretty levelly, but your protection needs do go up a little bit as children get a little older, get a little closer to being independent. Your saving needs will certainly go up. And of course, depending on your lifestyle, normally your lifestyle needs will go up as well. Once you enter into that retirement, again, your basic living needs will somewhat remain level, but your savings are replaced with health needs, because unfortunately, that's the way it is, that as we start to age, our bodies start to give out on us, even though we've done everything that we think humanly possible to keep good health. Sometimes things just happen. And then your lifestyle, early in retirement, your lifestyle and growth needs change, and you start to spend a lot more time fooling around and jacking around, but eventually, age does catch up with us. I think I just went backwards. There we are. So 5 reasons to have a plan. So we talked a little bit about this last week again, and one is to prioritize your financial goals and protect yourself along the way so your dreams are looked after. We're going to talk a little bit more about that. Save money to reach your goals, more of your immediate goals, but certainly long-term goals as well. Focus on the bigger picture. So it's not just about looking to buy that new car 6 months down the road. It's also looking at, what happens as the kid get to college, or what happens as we approach retirement. Organize your finances, which is the budget process we talked about last week. And ultimately, if you do all these things and follow the steps, The goal is to minimize your stress and your worry and provide peace of mind. So as it says here, a plan is more about saving money and buying insurance. It's about what you deserve to do or achieve in life, and it will help you figure out where you're going and how to get there. So insurance and savings is only part of the story. So what are your savings goals? Are you on the call tonight because you're closer to retirement and that's what you're concerned with? Are you on because you're concerned about your children's education and you're not quite sure what kind of things are available to you for that? Or are you more of just starting out and you're thinking, okay, I want to retire when I'm 52. What do I need to get there? Or if it's just a pure information session, that's fine too. You don't have to have a predetermined goal for being here tonight. I am not a lawyer. I do not do wills and powers of attorney in this province. You should seek out a lawyer. In the province of British Columbia, if you're listening from there, notary publics will do those as well. You can also do a handwritten, what they call notarized wills in this province. And if you want more information on that, I'm happy to provide that to you. I'm not going to spend a lot of time talking about it tonight. So there's three documents that are really important. The will is for your last will and testament, and you need to keep your will current, and you need to make sure you have an executor. And if you have children, you need to ensure that you have a trustee for those children. A lot of people that I've worked with over the last number of years, since I began, put the will on the back burner, and they'll take off on vacations to wherever and leave the kids at home. And if something were to happen to both of them because they're traveling together, that could cause a great deal of concern for those left behind. So as I always tell people, it only needs to be something as simple as a letter to one another. So you and your partner sit down, you write a letter to each other, and you say, this is what I want to have happen in the event of. And if it happens to both of us, this is what I want to have happen. And this is who I want to look after the kids. And that will go a long ways towards easing the stress and the strain on your children and your family left behind if that happens. And it does happen. So it's easy to say it'll never happen to me, but it does happen. Powers of attorney. So there's, in this particular slide, they talk about powers of attorney for property, powers of attorney for healthcare. In this province, we talk about powers of attorney for property, and we talk about directives, personal directives. So a personal directive is what you want to have happen in the event that you become incapacitated and your life is shortened. So you're on some sort of machine that with no chance of recovery. Who do you want to direct to do what needs to be done? Power of attorney is something that is used in the event that you fall on the ice outside and you hit your head and you become mentally incapacitated for a period of time. If you have bills to pay, you have checks you need to write, you have things of responsibility, financial responsibility that you need to ensure are covered, you need to make sure someone is there to take those matters over for you, and that's what the power of attorney is for. Some of those matters can be accomplished through a joint with rights to survivor bank accounts, but some cannot. And so again, I'm not going to spend a lot of time tonight drilling down to the details. I'm very conscious of the time, so I want to make sure that we don't run over and we leave enough time for questions. But if you have questions on that, certainly give myself a call or seek out your favorite lawyer. So non-controllable events. So we move up the financial planning pyramid, and that covers things like, what happens if you do become incapacitated and needed to become a dependent. You suffer major health issues, serious illness or dying prematurely. Those are all things that are pretty much out of your control. Yes, we can ensure that we're living as healthy as we can and exercise as often as we can and are able, do the right things, but sometimes life gets in the way and it's a genetic thing, or it's just a freak accident. So one of the things that we can deal with there, and it may feel strange to talk about this, but if you're 30 years old and you're saving for retirement, it's important that you have life insurance, not just to ensure that you're looking after, you know, your spouse or your children, but for the immediate, but also to ensure that they have some standard of living into retirement. And that's different for everyone. You don't need to be stepping out and buying $2.5 million worth of life insurance. You need to balance the need with affordability. And so we look at what kind of expenses would need to be covered in the event of. What are the sources of income that are available to the survivors? You know, the amount of insurance that's required, and then the types of insurance to make that happen. So there are 3 different styles, basically: permanent, term, and universal. They each have different purposes in life. They each have different costs associated with them. So that's, again, something that if you've never talked about these things with your spouse, with those that could be left behind, you need to maybe broach that subject with them. Consider how much you can afford, because I mean, the sky's the limit on this stuff. You can have a very pricey product, or you can have a very cost-effective product, depending on what works best for you. It is not a choice to not do nothing. You need to ensure that you've dealt with this. This is a major consideration. Life insurance is an unselfish product, and granted, you won't be around to see it if something happens, but you'll ensure that those that you loved will be looked after. So just a couple of facts and figures, and we try to keep this as light as possible, but really, I mean, how much lighter can you be when you're talking about illnesses and budgets and those sorts of things? But so 60%, this was as of a survey in 2017, 60% of all Canadians diagnosed with cancer survive 5 years or more. Now that's good news. Didn't used to be quite that high. Used to be that a lot of people never made it past a few months, much less 5 years. So 6.2 million Canadians aged 15 and over have had or will have at least one disability. That's a pretty sobering. And I don't know, you know, to what length of term that disability would exist. But, you know, given the circumstances that we're in today, if you've exhausted your emergency fund and you're living on unsteady ground, as we would say, the last thing you can afford to have happen now is a disability. If you've suffered a disability, you may not be able to get it in any event. But again, you need to make an informed decision, and you need to ask the questions. And I'll just reiterate again, you feel free to fire me an email or someone like me an email and get some information on this stuff, so that you're not being forced in to buying something under pressure. Excuse me. So these are, so when we look at some of the non-controllable events, health and injury wise, you've got the Canada Pension Plan disability benefit. And again, I have no interest in going into these in detail, or we'd be here for a couple of hours at least. Our time tonight, we're going to try and wrap this presentation up in 45 or 50 minutes and then leave time for questions. So there's CPP disability benefit, which if you're contributing to CPP, you're eligible for. If you're fortunate enough to work for a company that has a group life and health and disability plan, then you may have a workplace plan in place. You need to understand how that works. If you don't understand, or you're just not interested in it, you want somebody to explain it to you, feel free again to give me a shout or someone like me a shout. We'll do our best to do that for you. Critical illness insurance is, I call it life insurance for the living. Critical illness insurance, depending on whose product you buy, will cover major illnesses, so the heart attacks, the strokes, the cancers, the MS, those sorts of things that are life-threatening. It pays out a lump sum tax-free cash benefit upon diagnosis in most cases. And there's no, again, in most cases, there's no strings attached to it. So if you had a $250,000 critical illness policy, you suffered a defined critical illness, it'll pay out the $250,000 tax-free. You can get your house renovated. You can go seek treatment around the world. You can do whatever you want. It's just that simple. Long-term care insurance, with all of us living a little longer, this becomes more and more important. If you become disabled, for any reason, whether it's injury or illness, long-term care insurance will help to provide you income through for the remainder of your life, depending again on the product that you've got. So if that's of interest, you need to seek out your professional to get some information on it. Disability insurance, that's income replacement insurance. So that's like if you've got a group life and health disability plan at work, which will cover 50, 55, 60, 66 and 2/3, 70% of your pre-disability income. So you need to be aware of what your coverage level is, because if your living expenses exceed more than 50% of your current take-home pay, you may consider that you need to have additional disability insurance, because if you go off on disability, you don't want to not have something that you need. Okay. Personal life insurance, that is a lot of people in this province and across the country are familiar with Blue Cross. Those are plans like Blue Cross. They are personal and their health insurance. So they will provide reimbursement for prescription drugs, for massage, chiropractic, naturopathic therapy. Usually it'll provide some vision coverage, it'll provide some dental coverage, and the list goes on and on and on. So again, not here to sell you stuff, just to make you aware. Controllable priorities. So what do you need to look at there? So these are things like your education savings, like your home, ensuring that you're able to make your mortgage payments, like your retirement savings, your debt reduction, your personal savings, and your emergency cash. As we spoke last week, the emergency savings accounts have really taken kind of a beating with lots of folks. And back 30, 40 years ago, when they established in the province of Alberta the Heritage Savings Trust Fund, they called it a rainy day fund. Well, we're in rainy days, folks, and that's what an emergency fund is for, is to help you through those rainy days. So don't be ashamed. Don't beat yourself up if your emergency fund is about exhausted. You're not alone in that. And we just have to work to figure out a way to continue to carry on. This session and other sessions like it is about to try and ease your mind and give you a light at the end of the tunnel. It's not about piling on more responsibilities and those sorts of things. So again, feel free to call someone like myself and we'll do our best to help you through it. So money management tips. You've all heard pay yourself first. Easily said, sometimes difficult being done. But one of the steps in that process is to create a monthly budget. And last week, and that session is now posted to the Sinnott Arch site, and it's on YouTube, so you can go on and you can listen to that session, and you can contact me if you would wish to have a monthly budget worksheet. It will help you define and locate what your costs are and follow your spending. It's no magic wand. It's going to take some time to figure this out, and it may take you a couple or 3 months to get your your expenses and your spending in check, but it will help, and it's going to take some work. So I'm not going to sugarcoat it. It's you that has to do the work, and you'll reap the benefits. Have an emergency fund, yes indeed, but it takes time to build that up. So don't think that if you've exhausted it that you're going to do it over the next couple of months. Probably not going to happen. once you've got those two things kind of in place, then you can start to plan for monthly savings, start to pay off your debt and mortgages. And last week we talked about debt and the kinds of debt, good debt versus bad debt, and use credit cards with cautions more than ever, folks. You need to, and I know it's easy and sometimes it's the only way right now to use credit cards, but it's going to bite you in the long run. So do your level best to live within your means and pay as you go along. You get in trouble with credit cards, again, there's organizations, and I can point you in those directions that'll help you with some of those things. Or sometimes you can do it all yourself. You just need to settle down and consider it. So debt management. So the first thing you need to do, just like a budget, you need to set your debt limits. You need to factor your debt into your budget so that you know that, you know, you've got the very first things is you need to cover the roof over your head and your basic living expenses. So you need to cover your roof, you need to cover your gas, you need to cover your power, and you need to cover your groceries. And everything else outside of that, for the most part, is peripheral, and you can live without it if you need to. So you got to figure those things out, get a handle on them. Calculate the total cost of your borrowing so that you have an understanding of how much it is costing you to do this. Understand the implications of missing or late or minimum payments. We talked about that last week. Again, you can go back and watch that, or give me a call and we can talk about credit ratings and what missing payments and being late on payments will do, because that only has a compounding effect. And going through what we're going through today, there's a strong possibility that if you don't deal with it correctly, it could only get worse. Recognize debt trouble or potential debt trouble, and again, remember that you know, there's always a way to resolve it. It's you got to feel comfortable enough talking about it, then come to someone like myself or one of the many others in this country and find somebody that you can work with. You don't have to go and deal with the first person you can come across. It needs, as I've told my clients many times over the years, you need to be comfortable in your gut. And if your gut says you're okay, then you're okay. But if you're not comfortable, then find somebody else who will work with you and will speak your language. So right now there seems to be a huge demand for housing. I just heard on the news yesterday where something like it's a 60% increase in house sales in the city of Calgary. It's absolutely, in my mind, it's mind-boggling that in this time that housing prices are going through the roof, but it's because low interest rates. So some considerations to keep in mind when buying a home, if you're in that position right now, is buy when you are ready. Don't be pushed into it. Make sure you're ready and comfortable with the idea. Realize the financial difference between renting and owning. And that's something that, again, a budget will help you to determine and help you to quantify. Evaluate the true cost of borrowing and owning a home. It is going to cost you to own a home, not just the mortgage payments, but it costs for the upkeep and everything else. You're responsible for that. But I would suggest it will be well worth it in the long run. And know how much you can spend for housing. So as the orange box there says, despite housing affordability in the country, home ownerships and rates in Canada remain some of the highest in the world, and those appear to be only going higher. Just don't get yourself in trouble. That's, you know, interest rates are low. They're going to go, there's only one way to go when they're this low, and don't get yourself in trouble. 37% of working Canadians say they will have to delay retirement because they will not have enough money saved. That was a survey taken in 2018. I think it kind of speaks for itself, and certainly, again, I hate to keep coming back to this theme, but in this day and age, it's probably been pushed out further for some people. Now, on the upside of it is that there's a lot of folks, and I'm working with a lot of folks these days who are actually triggering retirement now because they don't want to have to work in the workplace under its modified rules. And they've done a good job of saving for retirement between their CPPs and their RSPs and their OASs and their maybe their workplace pension plans. And they've got the ability and the latitude to be able to go when they want to go. So even though this says that, some people are having to delay their retirement, there are others that are going earlier, and they're going earlier, making the conscious decision that maybe they won't be able to live quite the same kind of lifestyle that they had anticipated, but they're going to be able to go out while they're healthy, physically and mentally, and enjoy life. So one of the considerations, and if you're in that boat where you're starting to think about retirement, where a lot, again, I'm working with a lot of folks like that now, is what percentage of your working income will you need at retirement? And that's something that I can help you determine, and others in this industry can. On an average, again, averages, you got to make sure that you understand averages are made up of highs and lows. So there's going to be everyone on this spectrum. But on average, 70% of your pre-retirement income is what folks suggest they want in retirement. That allows you to do some of the extras, and particularly if you're retiring younger and you're in good health, you're going to want to do that. If you're being forced to retire because maybe your health isn't what you thought it might be, then maybe it's more than enough. 50% of your pre-retirement income to live comfortably, and 100% if you plan to travel. Those are, again, averages. You may not fit the average. I've got clients everywhere from 25% to 125% of pre-retirement income is what they're using in retirement. It just depends on who you are and what your aspirations are. Just going to check the time. Looks like we're doing great. So your expenses in retirement, so things that will stay the same will be your groceries, your vehicles. If you update vehicles right now every 7 to 8 or 10 years, you're going to probably continue to do that. Your property taxes, they're going to stay the same. They may go up. Your homeowner insurance will stay the same or may go up. Utilities, rent, all of that, and your life insurance. If you don't have permanent life insurance with a level premium, it may go up, but hopefully it will stay the same. Decreases, you'll see things like your mortgages presumably will decrease unless you're buying a vacation property somewhere and putting a mortgage on it. You're not going to have to contribute to Canada Pension Plan any longer. You're not going to have to contribute for EI premiums. You're not going to have work-related expenses, which may include clothing and gasoline and meals and those sorts of things. And your taxes should go down because your earnings are down. That's one of the things that working with professionals helps you to do, is to ensure that you try to minimize the taxes or effectively use the taxes by income splitting and other such vehicles. Things like hobbies, entertainment, travel, healthcare could increase depending on who you are, where you are, and what you want to do. So sources of retirement, and again, we're talking about your whole financial plan here. Right now, the government provides CPP and OAS. CPP will kick in at age 60 if you choose to take it that early. The optimal benefit for CPP is, age 65. So if you take it before age 65, there is a decrease in the benefit. If you take it after 65 up to age 70, there is an increase in the benefit. Then you'll have your company retirement plan, your personal RSPs, your tax-free savings accounts, and your other savings. Again, I apologize if I'm running a little fast here, but there's lots of room to ask questions when we get to the end, and you can certainly contact me individually as well. So the average, this was a survey taken in 2017, the average years in retirement for a male is 16 years, and the average for a female is 20 years. So that was based on retiring at age 64. So as a man, they're saying that your average retirement expectancy is to age 80, even though statistically our life expectancy is higher than that, and women's life expectancy is higher than age 84. But what this is showcasing primarily is, if we look to 30 years ago, lots of men weren't getting beyond age 70. And so we have to provide for a lot more years of income, which requires a lot more savings and a lot smarter savings. So what is an RRSP? Well, the first thing I'm going to say is the end of RSP season for the 2020 tax year is March the 1st of 2021. So today is the 17th of February. So that means you've got about 12 days. So if you're going to do something with RSPs or start to do some planning, you need to get on it and get at her, because you only got a few days left. It's a registered retirement savings plan. It's a savings plan that's registered with Canada Revenue Agency, and it allows deductions from your taxable income. It's not dollar for dollar. It's based on your marginal tax rate. So if you put $10,000 into an RSP, you're not going to get $10,000 off the top. You'll get the marginal tax rate of whatever you're at. And I can explain that to you if you wish. You have a wide range of investments. It's not just GICs or guaranteed fixed rates. You can go into mutual funds. You can go into segregated funds. You can go into stocks. There's lots of different options. Gains in an RSP are tax deferred until funds are withdrawn. They're designed to be drawn out when you enter retirement, when your income has gone down. And again, I can explain more of that in detail. And each dollar withdrawn is included as income and taxed. This is the major point as far as I'm concerned. I've had lots of people over the years have come in and bought an RRSP, and it helped them out that year, but life got in the way for them and they had to cash it out, and then they paid as much or more back in tax as they saved by getting it, because they were taking it out when they were in higher tax earning years. So those are things you want to very much consider before you take out an RSP, and maybe in some cases a tax-free savings account is better for you. Married or common law couples can consider a spousal RSP that can be used to save for retirement and lower taxes. There's definitely some real strategies involved with that. And again, we can talk about that, or you can fire me an email and I'm happy to explain that. So this just kind of gives you a little bit of a picture of what RSPs can do for you. So this is talking about an annual deposit of $2,000 a year in a registered plan, an RRSP, versus a non-registered plan. $2,000 for 10 years, $20,000 put in each plan. The non-registered plan, you're paying tax at a marginal tax rate of 35%. The rate of return on both these plans is 5%. So reinvesting the tax return in the registered savings account at the end of that 10-year period, your value has grown to $39,000. In the non-registered plan, it's only grown to $23,000. There's a $16,000 difference. It's for the purposes of retirement, an RRSP is usually the best way. It's not always the best way. It's certainly subject to everyone's different earnings levels and living scenarios. So this just gives you an example of how it can work. I'm not suggesting that it's the only way by any stretch. Spousal RSP, the contributor receives a tax deduction subject to the RSP limit of the contributor, registered under the lower income spouse's name, and helps balance retirement income between spouses to minimize tax upon retirement. What this is saying, in long story short, if I happen to be the higher earner in the family and we want to equalize incomes upon retirement, then it can be a wise choice for me to contribute to a spousal RSP. I get the tax deferral. The money goes into my spouse's account, and upon retirement, she will be drawing the money out of that account, and it will be taxed in her hands as opposed to my hands. That's how that works. The 3-year rule, that allows, if you're in those working years and you've got 2 clear years since you made a contribution to a spousal RSP, then the 3-year rule allows for that spouse to take the money out, and it's taxable in their hands. Be very, very cautious with this. If you're using this as a planning tool, make sure you get your dates right and make sure you understand how it works, because it can really bite you if you don't do it right. Government programs. CPP, again, as I mentioned, you can kick in as early as age 60. You have to have made contributions, and it's based on how much and how long you contributed. So then one of the next slides is going to tell you what the maximum was for 2020. Old age security, you can access that at age 65. Lived in Canada for at least 10 years after reaching age 18, and you have to be a Canadian citizen or a legal resident to qualify for that. The benefit is based on how long you lived in Canada as a Canadian citizen or a legal resident. Guaranteed Income Supplement, GIS. You must be receiving old age security, have an income of less than $18,600 annually as a single, or $24,576 as a couple, and it's only available to lower income Canadians, and that is based on your tax return filings as to whether or not you're eligible for that. So I'm not going to spend a lot of time on this. These are just the eligibility rules for CPP. If you're working for someone and you're under age 65, then they're very likely making CPP contributions on your behalf. So this is the benefits for 2020. So they've gone up slightly for 2021. I had this sheet opened to that amount, and where is it? No, I'm sorry. I fell off the screen there for a minute. I did have it there, but it will be up just a little bit. So in 2020, if you were drawing CPP at age 65, the benefit was $1,175.83. OAS was $613.53, and GIS was $916. The average monthly payment. So what that tells you is that lots of folks either take it before age 65, or they have reduced earnings leading up to retirement, so they don't qualify for the maximum benefit. So the average CPP payout on a monthly basis in 2020 was $672 a month, and OAS $572, and so on and so forth. That's what that's telling you. So how does the timing affect the CPP benefit? So at age 65, you get 100%. You get the $1,175, as we talked about a few minutes ago, for an annual benefit of $8,000. If you draw it at age 60, there's a 36% reduction. It's 6% per month, 0.6% per month. So 7.2% per year it's reduced by each year before age 65. So if you take it at age 60, your $8,000 benefit is $5,167. Likewise, if you wait until after 65, it goes up. So you'll receive a benefit of 142% of the $8,074, which will be $11,465. Everybody's different on this. I have lots of clients that have taken it at 60. I have some clients that wait till closer to 70. That's something that we have to have a discussion on, and it's based on everybody's needs and wants and life expectancy. So I can't sit here today and tell you should take it at 60 or you should not. If you want to discuss that again, seek out your advisor and have those numbers worked for you. What is a tax-free savings account? This is probably one of the most misunderstood money accumulation vehicles that there is out there today. Anyone over the age of 18 can contribute. While invested in the plan, your money grows tax-free. This started in 2009. So anyone that turned age 18 in 2009 qualified for the first benefit, and through till now, 2021, this slide says the $69,500 was the cumulative benefit as of 2020. That's gone up by $6,000. It's now $75,500. If you've never contributed to a tax-free savings account, you can put $75,500 in there today. If you turned 18 2 years ago, you can put 6 times 2, which is 6,000 for last year, and for the year before, you can put $12,000 in. Again, a very, very good vehicle. No good reason not to be saving your money in a tax-free savings account. Which of the following options about TFSA is true? So if we were in person, I'd be letting you read it before I ask the question, but it's called a savings account, but can hold a variety of qualified investments. So you can hold pretty much anything in a tax-free savings account that you can hold in an RRSP. So you can hold stocks, you can hold mutual funds, you can hold segregated funds, or you can hold GICs. A lot of people misunderstand that and they think they can only hold GICs. That's wrong. You can recontribute your tax-free savings accounts withdrawals, your TFSA withdrawals, but not until the end of the year, which is a fact. So if you take your money out of a TFSA today, you've got $10,000 in there, you take it out, you cannot recontribute it until the end of this year, till the start of 2021. If you do, you're going to be penalized on that. You don't have to be a big time saver to make it work for you. A TFSA and an RRSP don't have to be mutually exclusive, and that's an absolute fact as well. So you don't have to have one over the other. There's lots of cases where, in fact, probably the majority of cases you should have both. There are cases where RRSPs don't work for people, but a tax-free savings account does. So you need to consider whether that's right for you or not. Other personal assets can be used to top up your retirement income, and you need to understand the impact and the tax consequences of using these assets as part of your retirement savings. Excuse me, I got to have a drink for a second. So you can use stocks, bonds, you can have secondary homes or cottages, or you can even be utilizing your own primary residence for retirement income. So maybe your plan is to live in your own home till you're 70-ish, and then you want to downsize and you want to move to a retirement community. So you would take the money that you've realized on the sale of your home and use that for retirement income. Those are all things that we work into planning sessions to realize what it is you've got and what it is you need and what your expectations are. Just a short shout out here on saving for education. We will cover this in later sessions as well, but an RESP, those are retirement education savings plans. The federal government will grant you 20% of your yearly contributions to a maximum of $500 per year. So if you contribute $2,500 per child per year, you'll get a $500 grant from the government. This is another very misunderstood plan. You need to ensure that you understand the kind of plan that you're getting into, whether your contributions are contractual, that is that you have to keep them up month after month, year after year, or your plan could penalize you, or whether you're in a non-contractual plan and you can make contributions as you feel you want to. Both plans exist. You need to know which one is going to work best for you. You can go back and collect unused room. So fear not, if your child is 5 years old and you're just hearing about this tonight, you can still establish an RESP and make the contributions and go back and claim unused contribution room over the next number of years. earnings and growth is not taxable until withdrawn. It's taxable in the child's hands, and so presumably they're going to pay less tax. Your contributions are not tax deductible. So unlike an RRSP, an RESP does not allow you to deduct it. So the last little bit of this is just a little bit of a case study. I'm going to burn through this really quickly. He's 40 years old. He wants to retire when he's 65. He currently invests $1,000 a month into his savings, and he saved about $100,000 for his retirement already. What happens if he gets a serious illness? So what this slide shows is the blue one here on the top is scenario A. So annual investment of $12,000 to a registered savings, assuming a 5% before tax annual rate of return. By the time he hits age 65, he's up here at about 1.2 million, call it. At age 55, Robert develops a critical illness. Use your imagination. Maybe it was a heart attack, maybe it was something else. So he has to withdraw $100,000 to pay for his medical expenses. So the only place he's got to take that out of is his RRSP. As a result, not only does he pay tax on that, but it reduces the amount that's able to compound on itself. And so there's the value at age 71. So instead of being 1.2 million, it's now $900,000, $300,000 difference. If he chose to take his $12,000, pay some of it, so take off $1,700 for a critical illness premium, invest the rest, $10,000, $200,000, his critical illness would have paid out the $100,000. There would have been no need for him to have withdrawn the $800,000. And this yellow line here represents that he's almost bang on where he was. So not anywhere near the same kind of financial hit he had to take by taking his RSP. Not going to dwell on that any longer. We can talk about that if you want to look at scenarios that pertain to you. Finally, the last step in the financial pyramid is maximizing wealth and estate preservation. And we're getting real close to time, so we're right on time. Once your financial roadmap has a strong base, you can consider other growth opportunities. And without a plan, you're going to likely make inefficient use of your resources. You're going to be unprepared maybe for major catastrophes. You could pay higher taxes than necessary, and it could ultimately mean that your retirement is delayed or maybe doesn't exist. So one of the purposes of this, again, is to educate you. There is help out there. You don't have to pay a lot of money to get it. Ask the questions, find someone that you're comfortable with working with, and let's get on the road to some financial stability. It's important for you. It's important for all of us. Key points covered today: how much you'll need to retire, sources of income, and ways to protect your retirement. We have a really, really neat retirement planning program that we can get as in-depth as you want, and it's not just us, everybody has it. So you can go online and you can use tools like this, the Bright Start tool, the life expectancy calculator, or a financial checkup, and there's many, many, many more. I'm just showing you the ones that are related to Sun Life. So just Google it up and seek out the help that you need. There's my contact information again.